Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back everybody, let's update our view on euro currency. So you can see that performance of the recent week was not really tremendous. You can see that mostly market was flirting around the same consolidation and inside of the high wave pattern that we've got last week. So from that standpoint, nothing serious has happened and we do not see any reasons by far to change our major strategy, because actually daily chart remains bearish. We have the bearish direction by the trend. In MACD we have the divergence. Flag consolidation also has more bearish feature rather than bullish, and we're intend to keep going with the pattern that we have on the intraday charts. Meantime, in our fundamental report that we have prepared today, it's no doubts that the inflation data has become the major cold shower on the markets. But at the first glance it seems not really big changes. But the problem here is that it could really break the all Fed Reserve plans. So as we discussed last week, the major plan for the Fed Reserve is to last the time, endure the time until the mid of the year somehow. And when the changes in the economy will become critical, start cutting rates and starting some kind of the quantitative easing, no matter in what way it will be. By this action, they postpone the first splash of the inflation only next year, after the president election. And very high degree of the probability, this burden will be put on the shoulders of the Republicans. And they could be accused in all problems. And as you can see, currently, the Fed has not started yet even the rate cut, but inflation already starts rising. This has happened even without the component that we definitely will get in a few months from the Middle East conflict, as the logistics expenses right now are rising a few times. Additionally, the crude oil is also rising. This is the first moment. So it's very interesting what the Fed intends to do. And we suggest that the rhetoric in the January meeting, by the end of the January, and the 30th and 31st of the January, probably will not be as obvious as market right now expected. So markets currently understand nothing yet and still suggest that first rate cut should happen in March, at least by the Fed Watch tool in the Chicago Mercantile Exchange and the quotes of the futures on the Fed fund rate. Second interesting moment that we have discussed in today's report is concerning Europe, because if we take a look at the same logistics in the Red Sea, you will see that it breaks apart the trading process of the China with the Europe. But at the same time, the trading of the China with the United States stands intact because they are going in the opposite direction. So it means that heavy burden of the slowdown on the economy will make impact in Europe. Consumption will decrease, the prosperity of the population will start dropping, and it will make the cold effect on the production. So as a result, it just confirms our thought that we have announced previously, that we are skeptic on the idea that the European Central Bank stand later in terms of the rate cut after the Fed. So we suggest that it might happen that it will be vice versa, that European Central Bank will start cutting rate faster than the Fed. We will see. But currently with these geopolitical tensions, and we see the changing of the background of the overall global trading, we suggest that it's really very probable this will happen. And all this background, markets behave surprisingly calm. So you can see that the euro currency would not have any significant action. It means that the next week we mostly will be watching for the same strategy, particularly speaking in relation to the hand and shoulders that we have here. On Friday we said that overall price performance here looks weak and doesn't correspond to the idea of the possible upward rally. That's why we keep the same strategy. Currently, we still think reasonable, make an attempt to take some part of the opposition's bearish position right here, and if somehow market will show a deeper stronger upward action, to add more on this retracement. That's the major idea that we currently is following. On the hourly chart, picture stands the same, so you can see that market can't break this trend line and can't show this ABCD upward performance. But if it will be able to do, we consider another possible entry around 1030, 1040 area. On the hourly chart, the C point also starts playing an important role, which is because if market will break it down, it will be theoretical confirmation of the further downward action. Just action could be accelerating even, and bulls will lose actually chances to upward performance even theoretical, because this ABCD pattern will be erased, so market will start dropping back to the bottom of the so-called head. So, and well, it just means that starting of the active stage of this pattern performance. So we should get downside continuation. Alternatively, if we will see that hand shorts start failing and our strategy is not working, this market will moving above the 1040, 1050 area, that could mean that situation on the daily chart could change drastically. And I'm not occasionally keep these numbers here, so the 3-drive pattern still really could start working if market will be able to stay above this confluence. So once we see that flag is tending to be broken to the upside, it means that market could keep going to the 112 area, where the 3rd drive stand of this 3-drive pattern. So as you can see, really big stakes right now stands on the table. In the case of the hand shorts, it might be dropped to the 10750 area in a kind of the A, B, C, top, D pattern. If bearish scenario on the 4-time frame chart will fail and hand shorts will be erased, it means that market could go to the 112. So rather extended targets. It will be, from that standpoint, really interesting to see what will happen. But as I said, meantime, as this pattern is still valid, we don't have any theoretical or actual reasons to consider taking a long position, because major trend stands bearish, pattern is bearish, we don't have the bullish signs by far. So that's our view on euro currency. Next week, it will be important statistics of the consumption in the United States, which we also will be keeping an eye on. And let's see what will happen next week. Hopefully, performance will be faster than this week.